Well, hello everybody. It's November 8th. This is the weekly review where we take a look at what happened, what we believe is going to happen, how we should be positioned for it, and generally what should we be doing. The Russell 2000 was the standout last week. If you remember, early in the week, we decided to take a position in the IWM on the assumption that if the continued strength was there, we'd see rotation. And in fact, that is what happened, 3.3% higher. If we look elsewhere, still strength. Still up on the week. That's 6 weeks in a row. That's telling us just how strong this particular market continues to be. So if we look down and do kind of a quick review here, what we saw last week was the employment number on Friday strong. We thought it would probably be strong. We didn't know how strong. It was very strong. Pretty much sealed the deal on a December rate rise. And so it looks to me like December is going to be the go. I believe the market's pricing that in. How are they pricing it in? Well, you could do it one of two ways. You could pull back, you could take money out of the market, or you could simply rotate around. And it's the latter, at least so far. Now, we only had one day, but there was huge rotation on Friday, and that seems to be the intent. Not to leave, but to rotate. Where are they rotating to? Small caps, energy, financials. Where are they coming from? Interest rate sensitive stuff, dividends. And you can see that in just the spiders, right? The large 9 spider groups. Utilities, interest rate sensitive, big hit. Dividend stocks, decent sized hit. Where do they go? Financials, huge rise. And that's in the XLF. You even had bigger ones in the smaller ones, like KBE, KRE, KIE, all of those. XLE, rotation to it. Now, we had energy earnings last week also, which contributed to this, so it'll be interesting to see how energy behaves in the coming week. The fact is, though, that this market's rotating rather than retracing, and that's just underlying strength. That's what neoclassical is all about. Are buyers willing to buy at higher and higher prices? If they are, then you just have to assume it's going to go higher. You can make excuses to why it shouldn't. You can try to justify why it is or isn't, but it doesn't really matter. If they're willing to pay for whatever reason, if they're willing to pay up, then they're willing to pay up. I am certain we will get a retrace. We always do. Probabilities are 70-80% that you will get a retrace on trend transitions, right? Retrace, retest, regen. And so I expect that will take place, and we should try to take advantage of it when it does. But whatever the case, they want to buy, they being participants, want to buy this market, and they keep putting money into it rather than leaving it, even in the case of a strong employment number and the fact that the Fed's going to raise rates. We still will probably get that retrace, like I said, but whenever it comes, it's probably going to be a buy. And in the meantime, you just have to keep leaning long, right? And we have to take advantage of any kind of retrace that does come along and try to buy into it. Technically, NDX gets over the highs, stays over the highs. Let's take a look at some of these. Last week we talked about the NDX making that run up to the highs and tried to get over them. On the weekly here, well, the swing point high was 46.94, gets over it, stays over it, has volume, right, and trend transitions. Can we expect some sort of a retrace? Well, after this big run, sure we can. But the fact that it's done this just underlines the fact that this market is going to continue. It's not going to stop. And we kind of had a hint of that already when we were looking at, like, say, the S&P 500. And the S&P 500, if we look at it on a weekly, was able to get back over those retest regenerate zones. Remember, the reason we watch those zones is to see, is it an indication that, whatever that direction was, which in this case was, had turned bearish, is it an indication, or are we getting an indication that that trend is over, right? This is no longer the case, and instead it's sideways at worst, or potentially higher, which is what this thing is trying to do. And so, the fact that it was able to get back over these, even though percentage-wise, odds-wise, probability-wise, it should not have, the fact that it did and the fact that it shouldn't have tells us even more so that the strength here is serious, right? And it's probably not going to go away. And so we just have to respect and assume that's going to be the case, right? There's nothing else you can say about it. So that's the strongest index. And the next strongest one, of course, is the NASDAQ, and not the the big caps, but the broad market. Top there was 50.9269, gets over it. That was the breakdown bar. So here's one more piece of evidence that this market really intends to go higher over time. And finally, if we move over to the Russell that we were talking about earlier, the Russell gets over the swing point high here. You get over it, you have the volume. Again, good sign, good scenario. 70% probability this will retrace and retest off this bullish breakout now. But, it could just grind a little bit higher before it does it. The 70% is 70% on a confirmed breakout like this. 70% of the time it will come back within 6 bars. And so that's the Russell. Now the one that was unable to actually get over and stay over was the S&P. And there we had, let me pull it up to the weekly. There we had the attempt to get over the breakdown bars high. It did get over it up here, but couldn't stay over it. Actually closed under it. Still, huge, strong advance. Yeah, we can get a retrace. How much can we get? Well, back here to the support zone is probably the best case, right, at this point. I expect they will aggressively buy it if and when we finally get some sort of a retrace. So you got all that strength going forward. It's impressive. S&P didn't quite, align with everything else. If we look at the other technical negatives, though, they're all going to be related to dollar strength now. Emerging markets, because of dollar-denominated debt, is going to have a hard time. And you can see they're consolidating up here, but they're way below everything else, right? And they're going to struggle. They're going to continue to struggle. You're going to see struggles elsewhere. Those large caps outside of technology are probably going to struggle. The dividend stocks, as we saw with the utilities, are going to struggle. Interest-sensitive stocks, dividends like the XLP, interest-sensitive like the utilities, even real estate. I mean, if we look at the real estate market, like the REITs, right, the U.S. real estate, you can see volume expands, this thing gets hammered. And that's after it's made a huge run to the top side. These things are going to struggle. They have to. And along with them, you're going to see commodities struggle and bonds struggle too, especially the short end of the curve. Like here's the 3 to 7 Treasury bond. You can see how it's sold off heavily, right? This thing's all the way back down to towards the bottom end of the range. If you look even on the shorter end, you find the 1 to 3s. These things continue to get hit as well. And you can pull this back and look at it. So, the short end of the curve's going to flatten out. And then over in commodities, as you already know, you're going to get hammered on things like gold and silver and copper and, steel and all those. They're all going to get hammered, and they are getting hammered. They'll bounce just like they always do. But these things are not going to do well in this particular environment, right, as a result of the continued dollar strength. And before we leave that, let's just go look at the dollar. Dollar is pressing up, had a big spike up. It's pressing up here on the daily, on the weekly, breaks over those 2 swing point highs that were the target. Suspect volume. I don't pay quite as much attention to the volume on these ETFs because it's not always a reflection of what's really going on. And unfortunately, there are no good places to look because most of this is Forex. But this looks to try to go up here and go after these highs. And let me see what the top here was, 25.90. We got to 25.83. So that's the next swing point high. It's going to try to get over it next and reconfirm one more time. It actually would turn probably green on that breakout. But remember, we had, on the dollar here, we actually had kind of 2 ranges that were taking place. Well, it's clearly into the top of the range now. That means its target is those highs. And when this thing actually shoots over the highs, at some point, that is going to press hard against all the big multinationals as it did the last time it did it. So expect that somewhere down the road, and expect the next phase of the Fed question to not be, okay, are they going to raise rates? That's pretty much cooked now. It's going to like how much are they going to raise rates and how long? In other words, is this just the start of it? And if the market gets whiff of anything about this being more than a one and done kind of deal, then it's going to really probably struggle as a result of that, with even more rotation taking place. And so that's going to be the real question. I expect the Fed is going to emphasize as strongly as possible that that's a one and done kind of thing. Not so much one and done, but one and huge pause, right? I mean, they have to. They don't have a choice. They have to do that. So moving back to the notes here, to me, that's what this week told us. The positives, you're going to have rotation. It's going to keep this market going. They're not going to leave it, but they're going to really sell off some things and buy others, and we need to position in the others. Fundamentally, I suspect China is about to reduce the rates again. You can see it on the Shanghai market, where the push up came on some good volume last week, and you can see it's back over. I talked about it before. If you get back over this bar, the breakdown bar, then I'd start to believe that this market's for real. Well, it did. It's back over it. That tells me that more than likely this was the bottom, at least on the intermediate term time frame. So just as we look everywhere else, you look to see some sort of an evidence. What you'd really, if you're playing this market, I know some of the members are. If you're playing this market, the next thing you want to see is you want to see your bearish retest regen taken out, right? You want to see that done. You've already had the one that was down here that was done, right? So you have one good sign already. Now you're over this bar, which was a key footnote, right? Had to get over that. So now the next is up here. That's the next target in my mind as to where this thing's going to go. And, if you want to get back to the highs, this is the bar. You got to get back over this bar. And I suspect you're going to get a heck of a run once you do. And so that's the way this market's setting up. And I suspect why it's setting up that way is because China's going to reduce rates yet again. Market made it through another earnings season. Fundamentally, no real damage. That's got to be taken as a big positive. I didn't know if that would happen, but it did. If I think about the fundamental negatives, this rate hike is billed as certain now, and I suspect, it's going to contribute to some sideways action this week at best. But overall, whenever they give us a retrace, you're going to have to buy the retrace. And I know it's going to be hard after such a push, but that is going to be the case. And this stronger dollar, on a negative side, it's going to hinder the emerging markets, and it's where the debt is significant and the dollar denominated. So, if I pull over here and I look at for example, look at India. India is not participating, right? They're coming back down the other way. Brazil, same story. They're not participating. If I look at any of the emerging markets, it's the same story. So, don't expect this to be good for everybody. It's not going to be good for everybody. It's going to be good for some, and it's going to be bad for others. That's going to take some of the zest out of this move, right? Because you're going to get a lot of chop in various markets. But at the same time, if you're looking at just U.S. markets, it's being taken as a good deal, and it's probably going to drive them higher. If I think about what to watch for and what we were looking for last week, I was wondering would the Fed speeches be more hawkish after what the Fed said the week before. They were, and I was wondering if it would affect the market advance. It didn't. So they're more hawkish. It didn't. They just want to rotate, folks. And if I think about the other thing last week, I was wondering could we get those new highs on the NDX, and would we get over those bearish breakdown bars? We got over it on NASDAQ. We got the new highs. S&P's the only one that didn't give it to us. So we still have a little bit of divergence, but again, it's a strong market. What am I looking for this week? This rotation. We only had 1 day so far off the Fed numbers, and now the idea that the number is cooked in on December for the rate hike. Question is will this money rotate? I suspect it's probably going to do so, and the financials are going to be the biggest beneficiary of it. And what kind of retrace are we going to get? In other words, when we finally get this retrace, what is it going to look like? Are we going to get a deep one? If I look at the S&P, is it going to be deep? Is it going to come all the way back to a swing point high? Man, that would be a pretty good whack, I don't think that's going to happen. So then you have to think something else. If I go over to weekly, right, you got this big area here. All of that is kind of game on, starting with about 21. Let me get that number here. The low is 2067. I suspect that's probably as good as you're going to get. You might get to the low of this one, which is 2045. So somewhere between 45 and 67. That would be a decent sized retrace given the strength that we've seen in this market, and probably a good place to be thinking about buying some more. Economics, most of the data last week supported modest growth. I mean, it continues to be the same thing. It's been that way for 2.5 years. We kind of see this ebb and flow where at times it looks like recession. People get all worked up about recession, and then they all shut up and everything is okay, and then again you get it coming about again. The Fed speakers, they all more or less said the same thing last week. You got a slew of them again this week. And the inflation numbers, production numbers in GDP this week. It's kind of a quiet week overall. You actually have Veterans Day in the middle of the week that will also make it even more quiet. Bottom line here, last week we still weren't seeing any kind of technical signs of a pullback. NDX was trying to make those new highs, and it did. How does this week shape up in my mind? I suspect what we're going to see is continued rotation. And that rotation is going to lead to some sort of retrace probably, but I suspect they're going to aggressively buy it as it comes back in. What we should recognize is that 70 to 80% of all breakouts tend to retest and regenerate. You just had major moves in all these areas. What we should be doing is looking at these areas and trying to buy any kind of retraces they provide us. If we move to the portfolio last week, we took off and booked some profits in all these areas. We had some big moves on the dollar, as you know. I'm sure we'll get some sort of retrace there at some point. We want to buy in more. On the flip side, we put in some new stuff, CPE, BMY, GLD. I like the way most of this behaves. The only one that's kind of questionable now in my mind is BMY. I expect, given what the Fed did, these kinds of stocks are not going to benefit, and we're probably not going to want to be in it, so we're going to want to exit that. But we're going to want to add into these areas, either individual stocks or into the group. And we already did one of those right last week with CPE, which is an energy name. That stock is set up really well. Earnings came out, they got hit a little bit, but they bounced right back. That one's set up well. We're doing well with LAD. Any kind of retrace there is a good one. IWM, same thing. We should be buying that. Gold, I still like this spread trade. Sometimes it feels kind of heavy, but they're getting some good dividends off of it. You're going to have lower taxes on those dividends if you're playing it. And we just have to keep working it. At some time, gold, at some point here, gold really is going to spike and turn and go to a sideways trend at worst. It's still in the downtrend. If we look at gold on a longer term time frame, we haven't got the test yet, but you got volume down here and it's coming to test it. It's going to test it this week. This will be the test to tell us, is gold setting up just another leg to the downside, or is it pretty much done? Is this going to continue, or is this test going to hold and you're finally going to see some sort of sideways action in gold? And if it does that sideways action, it's going to be a big eye-opener, if you will, right? Because really, given everything else with the backdrop with the dollar, this should keep dropping. And if it doesn't, that's going to be a big eye-opener. Elsewhere, big moves in the EUO, YCS. EUO, I didn't want to take any profits on. YCS, I think you had to, and we did. Again, retraces here or buys. Same thing with our two core positions there. BAMX, which is BMW, I think we ought to be trying to take some profits somewhere on any kind of a move higher, because I suspect, and let me pull it to a weekly, I suspect what we're going to see is we're going to see the euro catch some sort of a tailwind back to the upside, and I don't think that this, we've had a good run is the point, right? We need to take some profits somewhere. We want to take some profits as we come into this area if we can. I was looking at it at 38. I don't know if we're going to get there on the first leg, so I'm probably going to take it somewhere lighter. and then try to get back in on any kind of retrace. That's the focus this week. That's the way this market looks. It turned out to be much stronger than I expected, and you can't always foresee every move, but you have to react to whatever does happen. And fortunately, we didn't take a big drop. And the whole neoclassical strategy is don't give your money back once you get it, and try to stay up with the market as best you can when it's going up, and make your money when it goes down. In other words, don't lose when everybody else does. And over time, you'll do as well or better when the market finally does have a big correction. We've had this last correction, and actually I want to show that. And to show it, I'm going to use the S&P 500. Now, remember, we had a consolidation up here from about 67 up to about 2132 for 7 months. And then you finally got the break, right? And you can see what kind of a fast move it made. You got the nice big bounce, which is normal, and then you come back down to test, right? And even though it didn't break, if you pull this over and you look at it on this time frame, and I'm on the weekly now, we had huge breaks here at the same time, again in that same area. You had it here and you had it there. And then not only that, then it took out this one and this one as well, and it only left the October lows. A break of this low would have transitioned the monthly time frame. In other words, that low on the monthly here on the S&P 500, that would have turned transition. Those transitions almost never happen unless they're really for real. In other words, in this particular case, had we gotten that transition, right, the break of this bar, then we would have turned the trend more than likely to bearish instead of bullish. It would have been sideways at first, but typically after that you get a bounce and then you finally get the breakdown. And so this was the first time in 6 years for a really good opportunity after a really long run to get a big reset. And I'm certain we're going to get one of those big resets at some point. This one had high probability, more so than anything we've seen now for 6 years, of actually doing it. And so, to be cautious on that, to be prudent about that, is what you have to do. Because we didn't lose on the way down, we don't have to make it on the way up. Sure, it'd be nice to, that's what you want to do. But you have to be prudent, and you have to take the odds and say, is this market more than likely going to work back, sideways to down and finally break? Or is it really going to prove that it wants to go higher? And it turned out that it still wants to go higher. And once it does that, then we simply have to go with it. That's the neoclassical approach, right? You protect yourself in those cases where the probabilities are high that you could get hurt. And when they prove to be true, you're much better off than everybody else. And where they're false, they don't happen, they don't carry through, then you simply turn and go with it again. And that's what you see me talking about. We haven't tried to short this market in the portfolio. We've simply just stayed with it. Sure, you can short-term time frame it and try to short it. But that's not what this portfolio is about. It's just trying to stay with the trend and trying to take advantage of it and trying to protect you in those cases where things are about to turn. So that's where things are. That's what we've done. That's what we're going to do and continue to do. And as always, if I can help you, let me know. Otherwise, I'll see you next time. Good night.